global macroeconomy is fraught with uneasiness, complexity, and conflict. Recent volatility in the month of August also suggests a cautionary outlook in the near term, especially as we head into the seasonally volatile month of September for global equity markets. Yet Singapore's fundamentals remain steady and could act as a safe haven amidst this volatility. Indeed, the ability of Singapore-listed companies to increase dividends above pre-pandemic levels places the Singapore equity market in a stronger position amidst global uncertainty. Here, we have a chart of the dividend per share of the Singapore Index constituents. Whilst dividends in 2020 understandably declined due to the COVID pandemic, constituent companies in the Singapore Equity Index have increased dividends per share to levels higher than pre-pandemic on a weighted basis. What has been driving this increase in dividends? In the financial sector, foreign deposit flows into Singapore remain unabated, especially post-pandemic. This data reinforces Singapore's strength as a preeminent financial hub in the Asian region, enabling it to continue to attract financial flows seeking stability. In the industrial sector, Singapore companies are well positioned to take advantage of tightening supply chains that result from deglobalization and geopolitical uncertainty. For instance, rising shipping freight rates caused by Middle East conflict this year have spilled over into higher air cargo rates. Both the marine engineering and aerospace-related industrial firms in Singapore can benefit from higher demand due to higher sea and air freight rates. Overall, we're pleased to note that the Singapore equity market is well positioned to grow from strength to strength. In the shorter term, a global rate easing cycle would make a dividend-paying market like Singapore more attractive to global funds. In the longer term, the process of deglobalization is inflationary in nature, as tariffs impose trade friction while supply chains lengthen and inventory levels rise to mitigate the risk of disruptions. Therefore, growing dividends would also make the Singapore equity market more attractive in the longer term, as global asset allocators may consider shifting bond allocations towards dividend-paying equities as an inflation hedge.